Hello traders, and welcome back to our Babypips course. For today we are still on course 10 of 11 undergraduate senior, and we've considered the course outline number 1, risk management, course outline number 2, the number 1 course of that of forex traders, and we are considering the course outline number 3, position sizing. So by the end of this video you should be able to understand what position sizing means, then calculating your position sizing. You should be able to also know how to calculate your position size in different forex pairs and account currencies. And then we're going to consider the summary of position sizing. So let's begin by learning the very first lesson, what position sizing actually means. But before we begin, let's roll the intro. So here we are on position sizing. We have already learned how not to trade too big or over leverage our account and using leverage properly. So it is now important for us to learn how to use proper position sizing. Now, position sizing is setting the correct amount of units to buy or sell a currency pair. Now, it is one of the most crucial skills in a forex trader skill set. You must know how to use this skill very well and correctly. So let's do that again. Position sizing is setting the correct amount of units to buy or sell a currency pair. How many units should you buy or sell? So like we have already established, it's the most important skill you should know, you should learn. So first and foremost, traders are risk managers. Okay, forex traders are risk managers. So you are a risk manager. You must learn how to manage your risk. In fact, risk before reward. So before you start trading real money, you should be able to do position sizing calculations even in your sleep. Do position sizing calculations in your sleeps. Okay, that is to say, finding the position size that will keep you within your risk comfort zone, and this is very, very easy to do. And we use this phrase, Babypips is saying, relatively easy, loosely here. Okay, so depending on the currency pair you are trading and your account denomination, either it is in dollar, euro, pounds, what have you, a step or two needs to be added to the calculation. Okay, so here is your scale. Okay, here's a trading account being weighed and how many units your account is weighing, and that unit is what you want to put. Okay, part of your trade account is what is what you want to use in any given trade. So now, before we do the math, we need 5 pieces of information. Now, the very first information we need is your account equity or your account balance. Second information is the currency pair you are trading. The third information is the percent of your account you wish to risk. And the fourth information is stop loss in pips. And the fifth information is conversion currency pair exchange rates. Now that's easy enough. So let's move on to a few examples of how to calculate position size. By the way, if you like the lesson, smash the like button and subscribe. So the next lesson says calculating position sizes. So here we are on calculating position sizes. So this is Ned. Ned is a newbie forex trader, and before he knew how to calculate position sizes, Ned has been blowing his account, and this is because he never knew what position sizes to use, leverage, and things like that. So he enrolled in the school of Pipsology on Babypips. So then Ned learned so many things on how to calculate position sizes. He learned how to use leverage and all of that, and so he began to do better. So if you don't want to blow your account like Ned, this body here, this newbie body, let's learn how to calculate position sizes. So if your account denomination is the same as the counter currency. Now the counter currency here means the quote currency. Okay, you know, we have base currency and we have quote currency. Let's use this for instance. This is euro and this is USD. So euro is the base currency and USD is the counter or quote currency. Okay, so now let's assume you are Ned, or let's use Ned. Okay, Ned deposited $5,000 into his trading account and he started to trade, and he started using, you know, the swing trading format now. And the trade he picked is euro USD, and he in his heart wants to risk about 200 pips per trade. Okay, so since he blew his account, he's now, you know, like he decided, no, I am no longer going to risk more than 1% per trade of my account henceforth. So he loaded up $5,000 and he said, I am going to be risking just 1% of my account. So you too, you have to do this. You have to determine your risk. 1% of your account, 2, 3, 4, 5, 6, 7, 8, 9, 10, whatever you are comfortable with. Okay, so this is Ned. He has $5,000 in his account and he wants to risk just 1%. So how do we get this calculation? 5,000 times 1%, that will give you 0.01. okay, and since it's 5,000, you're going to have $50 as the amount. Okay, 5,000 times 1%, that's 0.01. okay, now 0.01 is the lot size. Now 0.01 of 5,000 is $50. Okay, so next we are going to divide the amount, okay, risk by the stop to find the pip value. Okay, so he is risking 200 pips. Now he is risking, first of all, he's comfortable losing 200 pips of 1%. So 1% is $50. Now what would be the pip value of $50 as at 200 pips? So that's going to give you $50, okay, divided by 200 pips. That equals $0.25. That's 25 cents per pip. Now lastly, we are going to multiply the pip value by a known unit per pip value, a known unit pip value ratio of euro USD. Now in this case, with 10,000 units, okay, which is for $5,000 in your account or a mini lot, each pip value is worth $1. Now since we are having 0.25 cents per pip, multiply that by 10,000 units of euro USD divided by $1 per pip, that equals 2,500 units of euro USD. So Ned should put on 2,500 units of euro USD or less to stay within his risk comfort zone. Okay, otherwise he'll be, you know, going back to blowing his account, that is gambling. Now what if your account denomination is the same as the base currency? How do you go? So let's say he traveled from the United States and he's now in France. France used the euro, right? Now he decided to pick a French broker and deposit 5,000 euros in his account. Now using the earlier example, okay, we are going to calculate the value of the base currency, okay, based on the value of this currency, of this amount, will be calculated against the counter or the quote currency, right? So using the same example as above as we have used before, 5,000 euros multiplied by 1% will give us 0.01. That equals 50 euros. Now we have to convert this to USD because the value of a currency pair is calculated by the counter or by the quote currency. So let's say the current exchange rate for 1 euro is $1, 1.5 thousand cents, right? Euro cents. Now, so Euro USD is equal to 1.5 thousand euro cents. Now, all we have to do to find the value in USD is convert the current exchange rate for Euro USD and multiply by the amount of euros we wish to risk. So this is the conversion. 1.5 thousand dollar cents, 1.5 thousand dollar cents divide by 1. Quadruple fours euros, right? Multiply it by 50 euros, and that will approximately give us 75 US dollar. So next we'll divide your risk in USD by your stop loss in pips. Now 75 US dollar divided by 200 pips of stop loss equals to 0.375, a pip move, right? Now this gives or net the value per pip for the 200 pips to stay within his comfort level zone. So every pip that sticks in his favor or against him is worth 0.375 US dollar. So finally, you have to multiply the value per pip by the known units to pip value ratio. So 0.375 per pip multiplied by 10,000 units of Euro USD divided by $1 per pip, that equals to 3,750 units of Euro USD. So to risk 50 euros or less on a 200 pip stop on Euro USD, net position size can be no bigger than 3,750 units. So that's a little bit complicated, as you can see, but don't worry, we got your back and we'll explain everything so it will become as easy as baking a cake. Okay, I would love to give you how I do my own calculations, okay, so that it will be easier for you. I know some things are difficult, but before I do that, let's just check the next lesson that says how to calculate your position size in different forex pairs and account currencies. But before we get to that level, please smash the like button for me. Subscribe if you haven't. It only takes just 2 clicks. Like and subscribe. And I'll see you in the next lesson. How to calculate your position size in different forex pairs and account currencies. Let's go. So here we are on how to calculate your position size in different forex pairs and account currencies. Now, let's say you want to buy euro pounds and your broker account is dominated in USD. So let's say you only want to risk $100, but you're not trading US dollars. You are trading euros and pounds. So how do you calculate your position size? So in this lesson, we are going to learn how to do your position size if you are trading currency pairs that are not in your account denomination. I will shrink your position. Never. Funny, right? So if your account denomination is not in the currency pair traded, but the same as the conversion pair's counter currency, for example, US dollar account trading euro pounds. Now, Pairs, our example guy, our example guy, is back in the United States and he decides to trade euro and pounds with a 200 pip stop loss. Now, to find the correct position size, we need to find the value of net risk in British pounds. So remember, the value of a currency pair is a counter currency. In this case, euro is the base, pounds is the counter currency. So determine the to determine risk amounts in euro USD. That's the first step, determining the risk amount in dollars. So He's back to the US, and he has a US broker, and he's selling Euro USD, and he wants to risk 1% of his 5K account, which is $50 that he's risking. So the very next step is to convert the USD risk amount to GBP, right? So let's use the exchange rate of 1.75 thousand cents, okay? And because his account is in Euro USD, we need to invert that exchange. That's his account is in USD rather. We need to invert that exchange rate to find the proper amount in British pounds. So he's risking $50 multiplied by $1 divided by multiplied by £1. So the amount is risking is $50, right? Multiply by 1 British pound divided by 1.75 thousand US dollar cents. That will give you 28.57 euro cents. So this is it. $50 multiplied by 1 British pounds, okay, equals to 50 divided by 1.7500 dollar cents. That will give you 28.57 British pounds. So 28 pounds point 57 cents. Okay, now convert that risk, okay, amount to pips. So 28.57 pounds divided by 200 pips, that equals $0.14 per pip. Okay, so every pip is costing 14 cents, 14 British cents. Okay, 14 pound cent rather. Now step 4 is to calculate for position size. So what is the position size in total? Now we are going to multiply the known unit to pip value ratio. So the known unit is the pip value rather is 14 British cents multiplied by the known unit of 10,000 units of Euro USD, which is the account size, multiplied by 1 British pound per pip. That equals 1,429 units of Euro GBP pounds. So net can sell no more than 1,429 units of Euro GBP to stay within his predetermined levels of risk. Now, if your account domination is not in the same currency pair but the same as the conversion pairs based currency, if your account is in CHF, okay, Switzerland. So let's say he traveled to Switzerland, you are going to do the same thing. Okay, so if you want to do this by yourself, fine, but I think the first example is good enough for us. So we are going to move to the next lesson that says summary position sizings. But by the way, if you haven't smashed the like button or subscribe button yet, please smash the like button and subscribe. And let's go to the next lesson that says summary position sizing. So here we are on summary position sizing. So after joining across the globe with newbie nerd and through some basic position sizings, sizing examples, you are well on your way to becoming a competent risk manager. So now knowing how to set the correct position sizes is only a part of what it takes to become a pro at risk management. The other part is discipline. So stick to your stops and predetermined risk comfort levels, and you'll be sure to have enough after your losses to take advantage of future profitable opportunities. Stick to your loss. One problem I had personally was adjusting my stop losses, and the more I adjust, the more I incurred more losses. So it's better to just stick to your stop loss. Okay, if you are risking 200 pips, make sure it's 200 pips you are risking. Okay, if it's coming against you, don't adjust your stops. Okay, if it reverses and goes in your favor, great, but if it whips you off, okay, just close the trade. Don't take any more trade for the day. Okay, go, enjoy your loss, come back and find more opportunities to trade in the market next time, because over trading, indiscipline, risking too much, trading more than one positions at the same time causes in fact additional debt factors of forex traders accounts. Okay, to burn and blow your account multiple times. Plus you have to, you still have to suffer for like a year, 2, 3 or 4 before you really get to know yourself and to become more disciplined. So don't rush it. Okay, take it a step at a time. So the position sizing calculator. Finally, we know that you won't always have a calculator handy or a position sizing feature included with your trading platform. So here at babypips.com, we have decided to take it upon ourselves and have built a handy dandy position sizing calculator for you. So let's take a look at the PIP calculator. Okay, so what is the ask price? You have to pick an ask price. What's the position size? You have to put the position size. What is the PIP value and everything? And you have to just click on calculate. And once you say calculate, it will give you the unit that you are risking for that particular position. Okay, so come back and play with it. So use the forex position size calculator if you need it. Actually use it first every single time you decide to put a trade on. As the old saying goes, better to be safe than sorry. So before I call it a wrap on this lesson, let me tell you what I do for myself. So this is it's a live chart. Market is on. Today is Wednesday, Wednesday December 1st 2021. I'm making this video. It's 7:58 a.m. I haven't taken any trade yet, but I'm looking at what is it called, this US $500 index. Okay, US and poor 500 index. Did I say US and poor? US 500 index. So this is a chart of 500 companies in the United States. So what is my bias? My trading bias is that this market has been trading for a very long time in the uptrend. As you can see, up, down. Oh my goodness, this is white. We need another different color. Okay, let's use, what colors here? Okay, yes, let's use this one and this. So market has been rallying for a very long time to the top side, and it's failing to continue upward. Okay, and this is a very strong support. We have one here earlier on, we have another one here, and we have another one here. So in total 4 areas of support, and the market couldn't break this resistance. Okay, so we have been seeing resistance, further resistance, and this last one, it couldn't break this resistance. Rather, what happened? Price were driven down by the bears. Okay, they've had enough, no more going up, and it broke this strong support. Okay, so let me wipe the screen. It broke the strong support line, right? And price traded down, and the bulls tried to buy price back up, but this support kept holding the buyers. The seller said no, price will not move above this line. So the seller sold the market again, created a new lower low. Okay, this is a lower high, lower low, and the bulls are stepping in back again. They're saying, okay, we are going to try to push the price back up to this level again. And so this kind of thing always happens. So what I'm expecting is I'm expecting price to rally from this downside. Price to rally from here to this level here, okay, which it had failed to break earlier on. And this we call this pattern double top. Okay, so this is going to be like failure to break. Break below support level, a retest of support level, and exhaustion of prices, I pull back again. This is not a pullback, it's double, I mean another retest slash double top of this level. And if this position holds and we see a huge engulfing candle like we saw this one here, then that shows that yes, we are in a very good downtrend. But I'm not going to wait for an engulfing candle like this one you see here. No, what I'm going to wait for is to see how price comes here, and once price gets to this level, I'm going to look for something similar. You see these tiny candles here where I drew the support line. Okay, you see these tweezer tops here. Let me take it out. And I'm going to zoom in a little bit. Okay, you see these, you see this tiny here's my pen. Okay, you see this sign, these candles. Okay, you can call these tweezer tops, and we learned about tweezer tops in our earlier lessons. Okay, so I am going to wait to see how price comes to this level again. Okay, or let's say how price gets to this level. Now price move from this level to this place. Okay, and I see just one or two of these tweezer tops. Meanwhile, this is going to be 8 hours. This is 4-hour chart. So this candle formation took 4 hours, and this other candle formation took another 4 hours. Now, so if we see these patterns here again, if I even see one, okay, I'm going to place a self stop here, and I'm going to place my stop loss over here. My stop loss will be in this area, my self stop will be here. And how do I calculate my risk? Now let's do this again. Let me use this one this time. So this is the level I'm waiting for price to come to. Okay, now once price gets here, I'm going to calculate my risk. How many pips do I want to risk? I'm going to use the, what is it called, the structure level to calculate my pips. Now in this instance, okay, I will not be able to get it very right because, okay, I think I can do that. So this is 4669 and here is 5228. Let me give it a little space. 6394, right? No, 4669 4733. Okay, so 4669 is the entry minus 4773. So that's 104 pips. Okay, so I'll be saying, okay, I'm risking 104 pips. What is my account? The pip of the stop loss, I have calculated my stop loss range, and it is 104 pips stop loss. Okay, because I'm saying I'm placing my stop loss around here, this level here, right? Okay, I think I should go to trading view and do this so that you can really see what I'm talking about. So I am calculating the stop loss level or range, right? So leave here, I know, leave me alone, I accept. Okay, so we are looking at US 500. So here it is. And this is the daily charts, and I am looking at the 4-hour charts the other time, right? Okay, and we said that we are looking for price to come to this level, right? Price to come to this level. Okay, good. Now we just calculated 104 pips, and we are saying, I said I'm going to sell this market. So this will be, okay, let me put 104 here first. Stop loss should be, stop level should be, how many ticks? 104. I know it's going to be small because that is what we use. The calculation we used for to get it at my broker is quite different from this one. Okay, So I think it's around this level. Now this is about 1 to 62% ratio, risk to reward ratio. So let's make it 1 to 2 risk to reward ratio. Yeah. Okay. So this is my risk, this is my reward. So this is how the plan is. Once this price gets up to this level, I'm either going to put an instant execution or a sell stop. Now, what am I going to risk? How much am I going to risk? How much of an account am I going to risk? So let's say my account, for instance, is $100, right? For instance, the account is $100 and I want to risk, let's say, 2%. Okay, so 100 times 2%. Okay, so I am going to take nothing less than 0.002. Okay, so 0.002 times 100 is how much? 0.02 multiplied by 100, so that's $2. Okay, so if we are going to risk $2 of what is it called, of 100, what is going to be the lot size? Okay, so if it's going to be gets triggered or hit will be 60 cents. So actually we can increase our position size to 0.02, which we earlier calculated. So to do that, if you don't want to close this, right, to do that you can just take another position and make it the same. Now to take another position is just say the same thing, pending order, sell limit order 466868, and you place the order and you say stop loss 4279. Okay, and you place the order. What is it called? What happened? Place. Okay, I don't know what's wrong, but I think it has to do with the stop loss. Now we have the two positions already placed. Okay, it's now double. So this is what happens, and this is how you place the trades and everything. And you just wait for the position to, for prices to fill you in, and you are in the trade. And then once price gets to your take profit level, you then can now set your take profit level. So you can say, okay, I want to take profit in this level, in this area here, and that's 4528. And you come back here and you say take profit 4528, right? And you say modify, and your take profit is here. And so by the time the trade runs out, you'll be making a profit of $1.41. Now this is based on the lot sizes we put, right? So if it's your account, depending on your account size will determine the amount of money you're going to make, you know, based on your position and all that. So remember, it is risk before reward. So this is how I basically do mine. I use my structures to calculate my stop losses, profit targets, and all that. And this trade alone, if I was risking like $50, okay, it's gonna be like lots of money. Okay, like it can be like, you can come out, take profit can be like $150 or $300 and above and all that. So this is how I do my own position sizing. I only made this an example for you to, if it is simple for you to get it, fine. If you don't understand it, rather, you can use the pips code calculator to measure your position sizing and get a better, you know, format of doing your own thing yourself. So this is how we come to the end of course outline number 3, position sizing. So please smash the like button for me, subscribe if you haven't, and until next time, I will see you in the next course outline number 4 that says setting stop losses. I think we just did one, but we are going to consider it as well so that we can cover our Babypips course thoroughly. So enjoy. Please smash the like button for me, subscribe, and until next time, take care.